Hey, welcome to Get to College Chats. My name is Kierstan Dufour. I am Assistant Director and Project Manager for Get to College, and today we're talking all about some student loan terminology and situations. So we're going to be talking about loan deferment, forbearance, delinquency, and default. So this is for if you currently have student loans and you maybe find yourself in one of these situations, or you've had some financial changes that are causing you trouble paying your student loans, or if you are a parent or student that's looking to pay for college in the future that may involve student loans, or you're going to grad school and you realize that student loans are your main source of funding. There's a lot of scenarios that you may find this very helpful. So we're going to go ahead and get started talking about currently there is a forgiveness program due to COVID. Wasn't necessarily a forgiveness program. It's automatic suspension of monthly payments for student loans due to the COVID-19 emergency. So this was created and declared on March 13th of this year, and it provides relief to students, loan borrowers during the COVID emergency for federal student loan borrowers who are automatically placed in administrative forbearance. So we're going to talk about what forbearance means in just a second. It allows you to temporarily stop making your student loan payments. This suspension is current from March 13th, 2020 through December 31st, 2020. You can still make payments if you so choose if you currently have student loans, but this was issued in response to COVID-19. If you have questions to find out if your loan qualifies for this, you can get additional information on forbearance. You can go and talk to your loan servicer. So we're going to talk about a variety of very specific terms over the next few minutes. So I want to start out by talking about loan types, because this is going to be really important. Some of the information I'm going to share with you is very specific to certain loan. So let's start out. There are two loans I'm going to be talking about today. One is the federal Perkins loan. So if you currently have student loans, a Perkins loan was available to undergraduate, graduate, and professional students up until September 30th, 2017. The program has since expired, and what it is the Perkins loan is a subsidized loan, meaning that the federal government pays the loan's interest while the borrower is in school. The other type of loan we're going to talk about today is the William D. Ford Federal Loan Program. So if you watched our live last week, my colleague Brandy talked about direct subsidized, direct unsubsidized, and Parent Plus loans, direct plus loans. That is what the direct loan program. It's the federal student loan program under which eligible student and parent borrowers borrow directly from the U.S. Department of Education with those subsidized, unsubsidized, and plus direct loans. So know that I'm going to talk about Perkins and direct loans when we talk about today. So let's talk about a little bit more terminology in terms of payment. All right. So the first thing we're going to talk about today is deferment. So if you temporarily postpone your payment on a loan, it allows you to go under certain conditions, and during which your interest generally does not accrue on that direct subsidized loan, the direct subsidized portion of the direct consolidated loan, subsidized federal Stafford loan, and subsidized portion of the federal family education loan, consolidated loans, and federal Perkins loans. I know I just dropped a lot of titles, so what you really need to do is you need to go and check if you're a current student loan holder on your loan servicer account what type of loan that you have. All other federal student loans that are deferred will continue to accrue interest. So if you've got a subsidized direct loan in deferment, it does not accrue interest, okay? So forbearance. Let's talk about what forbearance means, all right? Forbearance is a period during which your monthly loan payments are temporarily suspended or reduced. Your lender may grant you forbearance if you're willing but unable to make your loan payments due to certain types of financial hardship. During forbearance, principal payments are postponed, but the interest continues to accrue. Underpaid interest that accrues during forbearance will then be added to the principal balance of your loan, which ultimately increases the amount of loan that you owe. If you are in a short-term financial bind, you may qualify for deferment or forbearance. With either of these options, it allows you to temporarily suspend those payments. It just depends on if interest will accrue during that time. If you're having trouble making your payments, you need to immediately contact your loan servicer and discuss your options, and in order for you to avoid going into default on your loan, which we're going to talk about in a second. So just know that if you hold a federal direct loan, which is that subsidized, unsubsidized, or plus loan, you need to contact directly your loan servicer to see if you could get into the deferment or if you qualify for the forbearance if you are unable to make your monthly payment. For a direct Perkins loan, you need to contact the school where you received your loan for details. If you know that your Perkins loan has been assigned to the U.S. Department of Education, you can contact the ECSI Federal Perkins Loan Servicer. You can Google that, ECSI Federal Perkins Loan Servicer, or contact the school where you got the Perkins loan. If you do not know who your loan servicer is, you can call Federal Student Aid Information Center. I'm going to drop a phone number for you, 1-800-433-4243, 1-800-433-4243, and you can figure out, and they will help you figure out who your loan servicer is. If you don't know who your loan servicer is, you need to figure that out. If you currently have student loans, that's who you need to be communicating all of this through. I'm going to keep talking about that today. You can also go on studentaid.gov under Manage Loans, or you can do studentaid.gov login with your FSA ID if you know that. If you have it, if you've done student loans since 2015, you'll have an FSA ID, and you can go in there and it will tell you who your loan servicer is as well. So when it comes to deferment and forbearance, there are two important things that you really need to consider. In most cases, interest will accrue during your period of deferment and forbearance. We kind of talked about what those differences are. There are certain cases of forbearance, such as what's currently going on as a result of the COVID-19 national emergency, that interest is not accruing. But it means that your balance will increase and you'll have to pay more over this life of the loan. So just because you aren't immediately needing to do payments right now, it means that it's still accruing interest every month, so your balance is still increasing and you're not combating that interest by making a payment. If you are pursuing loan forgiveness, if you're trying to do one of the loan forgiveness programs, any period of deferment or forbearance likely will not count towards your forgiveness requirements. So this means that you'll stop making progress towards your forgiveness until you resume repayment. So if you are temporarily in a hard spot, this may be a good alternative for you, but this is not a long-term fix, particularly if you're trying to move into like a public service loan forgiveness or one of the different federal loan forgiveness programs. I'm not going to talk about loan forgiveness today. That's a whole nother very larger conversation that I know y'all don't want to have on a Wednesday at 4. So we're just going to keep on about deferment, about forbearance, and then we're going to move into delinquency and default. One of the things that I really want you to do is, before you go into deferment or forbearance, is to consider another repayment plan option. Because the impact that interest and the potential loan forgiveness, it might be worth exploring repayment plans before you consider that option of deferment or forbearance. For example, if your payments could be more affordable if you change to an income-driven repayment plan versus a gradual or standard, which you may be defaulted on. Contact your loan servicer, again, we talked about this earlier, to find out if another repayment plan may be an option for you. So you definitely need to make sure you discuss your loan with your loan servicer, your immediate financial hardship need, see if deferment or forbearance are options. Our goal, Federal Student Aid's goal, Get to College's goal, is to keep you on the path to successful repayment for your federal student loan. We want you to avoid delinquency and default. If you're eligible for deferment and forbearance, you can temporarily suspend those payments, which may relieve some financial hardship before you get back on your feet. If you do choose to use deferment or forbearance, you may want to consider paying the interest that accrues during that period so you can avoid some of those financial long-term consequences, tacking on more money to your loan amount. As a former student loan person, recently paid it off, whoop, whoop. I totally get how right now it can be a hardship, and there's a lot going on with COVID, so we want to make sure you know your options. But if you missed your loan payment or you've realized you've missed it, let's talk about what happens when that occurs, okay? I got 2 more definitions for you. Delinquency. So a loan is delinquent when loan payments are not received by the due date. So this means that if your loan is due on November 18th at midnight when it turns November 19th, if you haven't done your loan payment, you're immediately in delinquency with your loan. This is not like a credit card that gives you a late fee. This is, you have to pay this. So if you're not on automatic draft, or if you missed a payment because you have been laid off or you're furloughed or something, just know you need to know that, hey, if my loan is due tomorrow, I need to be contacting my loan servicer to avoid missing the deadline on the loan delinquency. So a loan remains delinquent until you make up that missing payment or you receive a deferment or forbearance that covers the period when you were delinquent. So if you're having trouble making your monthly loan payments, you should contact your loan servicer to discuss the options to keep your loan in good standing, like we've talked about. So that's delinquency. So that starts immediately when you miss your loan payment. Let's talk about what default means. So default is the failure to repay a loan according to the terms agreed to in the master promissory note. For most federal student loans, you will default if you do not make a payment in more than 270 days. If you default on a federal student loan, you lose eligibility to receive federal student aid and you may experience serious legal consequences. So let's talk about how delinquency and default happen. I don't think anybody intentionally goes into student loan delinquency or default. Situations in life happen. So let's kind of figure out what happens when that occurs and how can you get out of it. Because we're all about helping you and giving you some free solutions at Get to College. So it's important to pay the loan amount as shown on your bill and pay on the due date. We reiterated if it hits midnight and you're not paid, it goes into delinquency. The first day you miss that student loan payment, your loan becomes past due or delinquent. Your loan account remains delinquent until you repay that past due amount or you make other arrangements like deferment or forbearance, or you change your repayment plan. If you are delinquent on your student loan payment for 90 days or more, your loan servicer will then report the delinquency to 3 major credit bureaus. If you continue to be delinquent, your loan can risk going into default. So don't ignore your student loan payments. Defaulting on your loans can have very, very serious consequences. If you have poor credit rating, which your student loan can affect this, if you go into default, even your delinquency can affect your credit rating. It may be difficult for you to obtain credit cards, home or car loans, other form of consumer credit. You may, as a result, have higher interest rate. You may also have trouble signing up for utilities, getting homeowner insurance, cell phone plans, approval for rental apartments, even some jobs run credit checks, okay? So you don't want this to stay with you. You want to make sure that you know your options if you find yourself in this space with student loans. So when a delinquent loan moves into default, your loan continues to be delinquent. It goes into default after that 270 days for a direct loan. The point when the loan is considered to be default varies on the type of loan. So like I just mentioned, for a direct loan, so that's a subsidized, unsubsidized plus loan, you're considered to be in default if you don't make a scheduled student loan payment at least for 270 days. For Perkins loans, the loans made under the Perkins program, the holder of the loan may be declared the loan in default if you do not make your scheduled payment on the due date. So while direct loans are 270 days, Perkins loans, you could be going into that default status, not just delinquency, but default status if you don't pay on the due date. So it's really important to know these. If you defaulted on any of your federal student loans, contact the organization that notified you of the default as soon as possible, so you're able to explain your situation fully and discuss what your options are. If you make repayment arrangements soon enough after your loan has gone into default, you may be able to resolve the default quickly. There are some consequences about default. So if you don't handle it very quickly, you cannot, the default can not only impact your ability to borrow, but it also impact your finances as well. Some of those consequences of default, the entire unpaid balance of your loan and any interest you owe becomes immediately due, which is called acceleration. You can no longer receive deferment or forbearance as an option, and you lose eligibility for other benefits, such as the ability to choose different repayment options. You also lose eligibility for additional federal aid or taking out loans for your children for federal student aid. If you need to do a Parent Plus, you can't if your loans are on default. The default report is then also sent to credit bureaus, which damages your credit rating and affects your ability to buy a house or a car or get credit cards down the road. So if you find yourself in default, I want to educate you and empower you to know how you can get out of default. Unfortunately, Mississippi has a large default rate, and so we want to make sure that you know, if you find yourself or you know family members that are in that situation with student loans, what you can do. So if you fail to make your payments on your federal student loans and now you're in default, don't let these consequences of default affect your financial future. One way to get out of default is to repay the default loan in full, but that's not practical for most borrowers, let's be honest. The two main ways to get out of default are either loan rehabilitation or loan consolidation. Loan rehabilitation takes several months to complete, while the loan consolidation is a quick application that you can do. However, there are some benefits to loan rehabilitation because it provides certain benefits that aren't available for loan consolidation. So let's dig in a little bit more to the loan rehabilitation and the loan consolidation options. If you rehabilitate a defaulted loan, that record of the default will be removed from your credit history. However, your credit history will still show that you had late payments that were on your record to your loan holder before it went into default. So it shows that you missed payments, you're in delinquency, but it doesn't show your default. If you consolidate a defaulted loan, the record of the default, as well as that late payment report from the loan holder, will remain on your credit. So while consolidation is faster to get out of default, the loan rehabilitation removes the default from your credit history. Late payments will still remain on your credit report for 7 years from when they were first reported, so it's important that you fully understand loan rehabilitation and consolidation before you make your decision. You can go to studentaid.gov and you can look up loan management and look up the differences. I'm going to, in just a second, kind of give you a brief overview of those two things. So in order to start the loan rehabilitation process, you must contact your loan holder. If you're not sure who your loan holder is, you can always log into studentaid.gov with your FSA ID and click View Loan Servicer Details to get that contact information. For direct loans, in order to do the loan rehabilitation, so the direct plus, subsidized, unsubsidized, there are two things you got to do. You have to agree in writing to make 9 voluntary, reasonable, affordable payments. This is determined by your loan holder. I'm going to talk about it more in a second. Within 20 days of the due date. And the second thing is you have to make 9 payments that were the predetermined amount during a period of 10 consecutive months. So under the loan rehabilitation agreement, your loan holder will determine what that reasonable monthly payment amount is. So generally what it is, it's amount is equal to 15% of your annual discretionary income divided by 12. So the way they calculate the discretionary income is the amount of your adjusted gross income from your 2019, if you're doing it now, 2019 federal income tax return, that exceeds 150% of the poverty guidelines amount for your state, so Mississippi, and your family size. You have to provide documentation as a part of the loan rehabilitation process to your loan holder about your income. So that's what we're going to ask about your most recent tax return. If you can't afford to make the initial payment that they calculated for you, you still have an option. You can ask your loan holder to calculate an alternative monthly payment based on the amount of your monthly income that remains after a reasonable amount of your monthly expenses are subtracted. So even though they may calculate from your taxes a certain amount that you can pay, if in reality currently you can't because your situation of living is different now, you'll have to provide documentation of your monthly income and expenses. You have to complete a loan rehabilitation income and expense form and submit it to them. And then depending on your individual circumstances, this alternative payment amount may be lower than the payment amount initially offered. But in order to rehabilitate your loan, you must choose either that standard amount that the loan holder provides or this kind of alternative amount that you work with them to determine. You have to pay either one of those amounts. Your loan holder may be collecting payments from your defaulted loan through two ways. You may be experiencing wage garnishments or treasury offset, which is withholding of your tax refunds or other government payments because you're in default in student loans. So these are called involuntary payments, and they may continue even after you begin making these loan rehabilitation payments. They are not counted towards your required non-voluntary loan rehabilitation payments. Just know these involuntary payments may continue to be taken until your loan is no longer in default or until you've made some sort of your rehabilitation payments. So the garnish of your wages and your tax returns are going to continue until you're out of default or you've worked through loan rehabilitation with your loan holder. Once you've made your required non-payments, your loan will then no longer be in default and you can set up your repayment plan from there. For the federal Perkins Loan Program, in order to rehabilitate your defaulted Perkins loan, you must make a full monthly payment each month within 20 days of the due date for 9 consecutive months. Your required monthly payment is determined by your loan holder, and you can go on studentaid.gov under Perkins Loan to get more information on this. And that other option that we talked about to get out of default is the loan consolidating, so consolidate your federal student loans into what's called a direct consolidated loan. Loan consolidation, it allows you to pay off one or more federal student loans with a new consolidated loan. In order to consolidate a defaulted federal student loan to a new direct loan, you must either do A, agree to repay the new consolidated loan under an income-driven repayment plan, or B, make 3 consecutive voluntary, on-time, full monthly payments on the default loan before you can consolidate it. So we've talked a lot of lingo today about student loans. We've talked a lot of scenarios, but we want you to know what these things are if you find yourself in financial hardship, if something drastically has changed in your life, because it's 2020, y'all. There's no telling what's around the corner anymore. But we want you to know if you find yourself in these situations, there are options. There are ways that you can work with your loan servicer or your school of origination for a Perkins loan to set this up. And if you slide into delinquency, how to prevent going into default. But if you're in default, how to get out of it, and then how to hopefully repair your credit as a part of that. We would love to help you. GetToCollege.org is our website. StudentAid.gov is also a great site. It's the originator of your federal student loan, so they've got great resources there to help you. Feel free to make an appointment with any of our counselors to chat in depth. Make sure that you complete your FAFSA. You have to have it on file in order to get federal loans. And if you want more information about it, make sure and check out our videos and watch Brandy's description of federal student loans. Have a great afternoon.